Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. I want to give a little bit of context to who we are, which helps set the stage for the discussions we have with amazing thought leaders. I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail in times of crisis. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose, refining vision, governance, structures, systems, processes, and culture that successful families and their safeguard family offices need in order to thrive. I help families create or reinvent their family office to be of institutional quality and highly adaptive. Today's topic is advanced insurance planning for extraordinary tax and wealth preservation benefits for the super rich. It features Brian Batson, partner at Krupin Partners, and Judas, Esquire, Life Insurance Strategies Group. Why don't I start by saying, welcome, gentlemen. Brian and Jay, how are you?
Good. Thank you.
Good, Angelo.
Always a pleasure. This is a topic that I think is going to go deeper than what many of you would perhaps even expect. First, listen to what I said in my open, and my members know it is one of my catchphrases, especially for family offices. And those two words put together are solve problems. For sure, life insurance and the way that we're going to talk about it today is something that definitely solves problems. It's a resource. There's multiple resources, and sometimes they're intellectual and strategy perspective, and sometimes they are product specific. And in terms of solving problems, I think life insurance is a very powerful vehicle. When I did my now legendary research with my 7 families this summer that are my largest relationships in FOA, and again, I came away and they were all heads of their SFOs, pretty positive about their outlook for the future, although mitigating and hedging risk, but adapting during today's times was very important. I did ask the question, and all the families that they individually represent, and again, these are all near $10 billion plus families, had life insurance, probably wish they might have had more at a younger or earlier age, and they're using it for very advanced purposes. So the best of the best among the top 100 families in the world, I could attest to you, I know, I asked, they have it, and they're using it for very advanced purposes. There's tremendous benefits of life insurance that cover tax, estate, wealth preservation, and income and investing as well. And this is why you see the super rich maximize the value of their life insurance and resources. At minimum, what many of you are going to be familiar with it for is it provides a lump sum when it's most needed of tax-favored resources to replace income and cover a family's expenses and debts. That absolutely goes back to what I said earlier about solving problems. Gentlemen, why don't we get right into it? Right now, there's a lot going on around estate planning. We understand that maybe not as much the public markets, but private market holdings, real estate, private companies, depending on the valuation, limited interest, limited access for control, et cetera, it's an opportunity for valuation to get it lower and to potentially lock that in. So our audience is going to be pretty familiar with intentionally defective grantor trust, with GRATs, and strategies of discounting certain resources. But coupled with incredibly low, I'm going to say historically low interest, it's like the perfect storm from an estate planning perspective. I know it's not always what's families want to jump into with great joy, but it's something that they need to turn their attention to, because who knows how long those kind of perfect conditions are going to last. Also, with the unified credit being the highest it's ever been, in theory for a couple of more years, but that is likely to certainly be a lot less. And there's lots of negative things that could happen from an estate and tax perspective in the coming months. Brian, why don't I start with you? Is now a great time for estate planning, and is life insurance one of several but valuable resources to a family addressing these issues?
So now and again, throughout our lifetimes, there are certain catalysts that come about that really drive and become an impetus to want to do planning, and becomes very present where it's on people's mind where, we really got to do something about this. And as you mentioned, Angelo, it's not always something that people really want to spend time doing, going outside of their normal day-to-day to take time out from their operating activities to go and spend time on personal planning. And there's a lot of difficult questions to answer in there. But you have these periods in time where it becomes absolutely paramount that we act. And so it's just such an interesting dynamic right now where, for all the reasons that you mentioned, there is a lot of motivation right now to do that planning. And with planning, I mean, again, when we come back to insurance, everybody needs a life insurance policy like they need a hole in their head. But what insurance is used for is it's to create liquidity, or it's to create and solve problems, as you mentioned. So if there is a liquidity obligation that is identified now that we can plan for, how do we do that and we solve that? Well, one of the best tools to do that is with life insurance, in large part because of the tax treatment of life insurance, but also if bought correctly, it can become probably the most tax efficient or cash flow efficient tool also, which then also comes back to some of the premium finance activity right now. There's a lot of premium finance activity going on to finance life insurance policies where we're using a third-party lender to pay the premiums. There's a lot of that going on right now because we're in a historically low interest rate environment. So there's opportunities, one, to do planning, there's motivation to do planning, and there's cost efficiencies and still tax efficiencies on the life insurance side that just make it all kind of marry up very well. With that, I'll let Jay maybe pipe in, but I think he's probably seeing some of the same things from that we're seeing here.
Well, yeah, and so for folks that know how Brian and I work, so Brian's a partner of a major producer firm out in California, and they work nationally. And my firm is a fee-based consulting firm. So we don't sell life insurance products, but we're often engaged by affluent individuals and families to help them structure a life insurance need or even decide what that need is. And so sometimes in our work, there isn't a life insurance need, and sometimes it's not what people thought. So what we're seeing, and Angelo, go back to how you started it, is absolutely what we want to see people do is to make use of that unified credit right away, which is at $11.5 million right now, and is going to go away and could go away sooner than we think if everything happens like it's looking like will happen come November. And when we use that unified credit, we like to see it done in a meaningful way. So you hit on some of the things that we want to see done right away. Is if there's family business interest, we want to see that discounted to the as much as possible, 30% more if possible, and get that moved out of the estate. I think a lot of times we see people that say, "Oh, I'm going to move stock portfolios, and get it out of my estate." But if you have things in there that are dividend producing, the value is not going to go up, and you're taxed on dividends, and as a grantor, you're paying those anyway. So why have those out of your estate first? So those are things that we like to see. And then, like Brian said, this low interest rate environment we have is making it perfect. I know we'll probably touch on premium financing a little bit, but some more of these advanced strategies people use to buy insurance. And I think another one of those that really helps people move appreciating assets out of an estate is split dollar strategies, which also, is a loan to your trust. So, I mean, we can go anywhere from here, Angelo, but it is, as Brian says, kind of a feast for planning right now.
Yes, and I think that was important to cement home for a variety of the reasons I noted and you noted as well. And a lot of the benefits that are there may not be around in a couple of more months. We actually have situations with the top estate planning attorneys where they're basically telling me their schedule is booked. There might always be a little bit of room for the right client, but that being said, if you don't start this soon, there may not be enough time. And Brian could probably talk a little bit, because we've had these discussions with him and Mike Krupin before, that sometimes that last quarter of the year is a tremendous time. And not only are you likely doing year-end planning, and this is going to be more extreme than ever before, but Brian could get into that, especially come November, December. That's probably when some underwriting considerations are going to be a little more flexible if you're dealing with the right experts relative to their engagement with the insurance companies to pushing some things through, period, and sometimes on a more favorable basis than other times of the year. In other words, the insurance companies want to do well to wrap up the year as well. So they're more likely to accept in especially significant premiums from ultra high net worth individuals. Brian, maybe you could go a little bit into what that process looks like and why what I said is true and why now is such a timely period of the year.
So let's take a step back. So let's think about how the year has gone for the insurance companies. So again, just how this all kind of shapes up coming into the fourth quarter is, because of COVID, things really were put on hold for a lot of us on the production side. And part of it was just clients, because of uncertainty, saying, hey, you know what, right now it's not the right time. Or because insurance companies actually were coming back and saying, you know what, right now we're going to start limiting the number of applications we take in, the amount of premium we take in, the amount of capacity we underwrite. So there were some dynamics in the marketplace that made Q2 and Q3 a much lower volume for the insurance companies. So they've already written off and are taking a hit this year. And some of the companies, you would be astounded by the amount of or just the year comparison where they were at versus last year or historically, just how much that is down. But they still want to finish the year strong. So heading into Q4, they want to have a really big pipeline and they want to get a lot of business underwritten. They also want to head into the next year, 2021, hitting the ground running and getting a lot of business done in that first quarter. So we always have this kind of Q4 opportunity to go to the insurance companies and based on what their year-end goals are, use that opportunistically and get underwriting that we may have not otherwise gotten earlier in the year, but now that compounded with their hunger to really drive business, it's making for some really unique underwriting opportunities, both from an underwriting classification, which again drives costs down. And anybody who ignores that is doing their client a disservice. So we want to make sure we get the best underwriting possible. We spend the time to do it. And two is getting capacity underwritten. So the ability to be able to get reinsurers on board, to be able to take on capacity at those same underwriting classes. There's appetite in the marketplace right now to argue for the client and on their behalf. So we are heading into a really strong period from an underwriting standpoint, Angelo, and we're certainly active right now, kind of using all those levers for the benefit of our clients.
Yeah, I mean, it's just simply a tremendous utilization for those that have the liquidity, and premium financing could help with that. We're going to dive into that deeper in relatively a short while. But a lot of the families of great wealth own assets that not only could they get discounting and various complex estate strategies to leverage at the moment, but they likely do not want to have to be liquidating or forced to liquidate real estate or private holdings at the moment, it's probably not a good time. They're probably going to be walloped with, depending on the kind of real estate, maybe 20 or 40% less than they would have gotten even pre-COVID. So that's a problem that a lot of ultra wealthy families worth hundreds of millions to especially the early billions fall into. Yeah, they have the resources, but to pay the estate tax, they're now going to have to liquidate those resources at a discount at a very inopportune time. And that's the magic of life insurance, is it provides, in some cases, hundreds of millions of dollars of cash when it is literally most needed. Jay, let's jump a little deeper into what we spoke about. So we spoke about something called a unified credit. And again, we probably don't want to make this a super deep estate planning conversation, but that used to be as low 20 years ago as about $650,000 a person. So for a couple, about 1.250. It's crept up. It's now at 11 billion plus. However, there's an extremely good likelihood that that amount is going to come down. If you could talk about how a family could lever that unified credit potentially into life insurance, and why that's going to provide a significant, depending on the age and health and a variety of factors, but a significant tax favored benefit to the family when it's needed most.
Yeah. So that unified credit, I think right now we're sitting at 11,580,000 per person. So for a married couple, that's $23 million that could be in value, that in assets that could be exempt from federal estate tax. So what you want to do is make use of that credit, as soon as you can, with appreciating assets, and get those out of your estate so they grow, where you can leave them via a trust, to your heirs. And then inside that trust, of course, you'd be buying a life insurance policy that would help pay for the taxes that are due from the rest of your estate. And what you said there, I think, Angelo, when we talk about, liquidity problems of, what can we move and what can't we move? And the idea of, maybe we're moving illiquid assets into a trust, how do we get insurance? And we'll get into those sort of ideas of using leverage. But this unified credit that we have today, we know it's not going to stay. We know there's already a sunset provision at the end of 2025, where it will fall from where it is today, over 11.5 million per person, down to about 5 million. In the next few years, you do get little increases for cost of living or inflation, around $300,000, $400,000 a year. But just because there's a sunset set today for the end of 2025 doesn't mean a new Congress in implementing some austerity measures couldn't say, hey, let's knock that down. And to be honest, the U.S. government doesn't make a lot of money from estate taxes, but it really looks good on the sort of the progressive agenda to go after that exemption. So where we saw it was going to go to 2025, it may not. So I tell people, let's use it today. And if it doesn't, great, you get an extra $300,000 or $400,000 a year until the end of 2025. Of more exemption that you can move money out of your trust or into your trust.
And Jay, so I think people are broadly familiar that life insurance is income tax free, and that's a tremendous benefit. But for the advanced uses of tremendous amounts of cash when it's most needed and leveraging the unified credit, the more advanced purposes that we're talking about, it is not necessarily free from not being part of your estate. Right. So it needs proper planning to how to own and structure the life insurance inside various trusts and using crummy provisions. Now, we probably don't want to bog it down with an hour discussion about it, but I think it maybe needs 2 or 3 minutes to give some context that just because it's income tax free, you still have to have the proper architectural structure of how you're doing it. And it's mostly science, but a little bit of art to get the most value out of it. So it's income and estate tax free.
Yeah. So if you're not a wealthy individual, owning an insurance policy in your own name, you're probably not going to have enough value where you're going to trigger an estate tax, owning $1 million term policy or $2 million. But if, we're talking about owning 20 million, 30 million of life insurance death benefit, if you hold that in your name or, in your estate, you get taxed, that's pulled into your estate valuation. So in effect, maybe you needed $1 of life insurance to pay estate taxes, but now you need $1.50 because your own policy counted towards your estate tax. So what we want to do with large policies is buy them outside of your estate in a trust. So, irrevocable trust, there's ways for it not to be irrevocable, but, for the sake of discussion today, so we don't, spend an hour on it, we want to get that into some type of irrevocable trust where the government looks at it and says, okay, you really don't have control of this policy, which, through trustee features and things, there's some element of control, but it's out of your estate. So the death benefit now is paid into the trust income tax free, and your heirs or the beneficiaries of the trust can then use those life insurance proceeds to pay off any estate taxes that are due. So again, don't own that policy yourself. Now, I will tell you, there is sort of a complex strategy, or people are saying, there's something out there now saying, hey, if you buy the policy in your own name and you wait 3 or 4 years, the government lets you discount the value of that policy, the cash value, when you move it into a trust. So let's say you paid a $10 million premium. Maybe after 4 years, the government says, oh, we'll value that at $7 million. Well, that's great. That does save you some unified credit. But if you have, if you die in those years you're waiting, you've really messed up, in terms of having that in your estate. So keep it out of your estate if you're buying a big policy.
Yeah, I mean, it's an interesting time that we're going through. I think everyone would agree, even if it doesn't happen at this election cycle, given a variety of factors, the federal deficit, the ongoing coronavirus, the, adding more and more to our deficit, coupled with simply a reflection of the millennial and Generation Z and them coming to more fruition and their beliefs. I'd be shocked if we're not going to have higher taxes. So there are certain other advantages that are likely you could utilize in life insurance for the purposes that we're talking about. So what we're talking about now is, forget about 2025. It's possible that the exemption from estate taxes may be much, much less than the approximate 23 or so million for a married couple it is right now. That could go away at minimum. Again, depending on who gets elected and who controls what, the estate tax rate is going to go up. Some states, unless my state in Connecticut changed, we had an individual state estate tax. So you get really, although there's some crossover exemptions and benefits, and again, we could get really complicated with it, but let's broadly say the estate tax is not going to go away. There was a little bit of tremble of thought of that even years ago. No way that is going to happen. It's going to get less of a unified credit, more than likely, and the rate is going to go up from whatever the mid 30s now to probably the upper 40s. And that's what the Democrats recommended in their proposal. So, I mean, if you do the simple math, if someone's worth $1 billion, they're going to owe a hell of a lot of money to estate taxes. And life insurance is simply going to be relatively a simple, effective solution to address that. Maybe a little more for Brian. A question, and I believe Krupin Partners last year might have written in the US the largest singular death benefit for a person. So you guys are used to doing extremely high level life insurance, sometimes well into the hundreds of millions, sometimes $500 million or more. So if you could talk about, for an extraordinary wealthy families, like those 7 families that I met with this summer, although that would even be at another level, what's the most that let's say a couple, so it's more for estate planning, could likely get in today's market, including reinsurance, as a combined death benefit?
So, and let me just preface it by saying you're certainly not going to be able to address probably 100% of an estate planning need with life insurance for somebody worth $2 billion and above. But it still provides a very, very lucrative liquidity piece that or bucket that can be used to supplement any obligation. So right now, if we stacked up the individual insurance companies' retentions and we stacked up what we could get out in the reinsurance marketplace, a rough guess right now, probably around 250 million of life insurance. Now, there's always exceptions based off of age and health where we can get more retroactive reinsurance on board, where we can get closer to 300 million. But I would say that roughly around 250 million.
And that would be for a couple or per individual?
For a couple.
Yes. And you are correct. For someone, once you start to get above $1 billion, especially $2 billion, even in a non-COVID market where the reinsurance is more open and maybe you could get that number up to $500 million or a little more of insurance, it still is going to be a valuable strategy, as well as some of the other, the FLPs and the GRATs and the a whole intentionally defective trust and certain gifting strategies. But there does come a point, probably when you're kind of in that Forbes 200 level at about 4, 5, 6 billion, where it's all good as a cumulative what you could do in various complex strategies. But at the end of the day, there probably is, unless you gifted assets at a really, really early discounted price a long time ago, there is going to be money owed in estate taxes at that level. It's just hard to get around that unless, well, there is one way, but it's not going to really be under total access. We didn't even get into CRTs and CLTs. Those are charitable strategies, but complete philanthropy, gifting, or a foundation would be one way. Jay, let's turn our attention a little bit to other benefits other than leverage for estate tax benefits. There also is tremendous income tax benefits in their own way in the accumulation. Now we're talking cash value, more likely in the case now, whole life policies for the super rich, where the money accumulates tax deferred. If you could talk a little bit about that and how it can be accessed very uniquely as first in, first out to basis, followed by wash loans. So that does make it a very powerful tax accumulation strategy as well as distribution.
Yeah, so you hit on sort of the three-legged stool that life insurance has advantages over other investments, and that's the income tax-free death benefit that we talked about. Then there's the income tax buildup inside the policy and the income tax-free way to take money out. So inside of a life insurance policy, as long as you meet a certain minimum amount of life insurance coverage, so the amount of death benefit, if you meet a certain amount of death benefit coverage, your money that you put into the policy will grow tax-free. So whether it's invested in mutual funds underlying the policy, or they're fixed accounts like many whole life policies or universal life policies, the premiums that you pay are going to grow on a crediting rate or some type of interest rate, which is fantastic. You don't have that, in other types of investments. And then when you want to take money out, there's really two structures of tax compliant policies in the U.S. So we'll try not to go down this rabbit hole too far, but one is a MEC policy where you pay a single premium all at once for your coverage. And if you want to take money out, you're taxed on the growth if you want to access the cash value. But the other way is if you pay a series of premiums, maybe as little as 3, possibly as little as 4 annual premiums, you're buying what's called a non-modified endowment contract. And if you have this non-MEC, you're able to access it for loans. And when you take loans out of a policy, they're tax-free as long as the policy remains in force. So you don't want to lapse the policy because they're going to come back to you and say, oh, we're going to tax you on the gains at ordinary rates. And you'd be like, oh, gosh, I should have just bought mutual funds. But if you do it right and you pull money out and leave enough to keep the policy in force until you die, you're not only going to get all that money out tax-free of the policy, but you'll be left with a residual tax-free death benefit. So what this boils down to is sometimes if you do this apples to apples with a, say, a mutual fund investment, let's put $1 million into a mutual fund every year and $1 million into a non-MEC policy. It wouldn't surprise me if you can get a lot more money out of that life insurance policy, making sure you bought a minimum amount of insurance to maximize that growth.
Yeah, I mean, I think it's gravely underestimated. And again, the super rich appear to know this, but so all of us could get a little better educated, not only the tremendous potential benefits we described at death, but it absolutely has benefits while living relative to, especially in a whole life policy that's going to be designed in a certain way. And some of the reasons that you noted, the accumulation via the internal dividends, and we'll get with Brian in a second about what some of those rates have been adapted during COVID, but accessing as first in, first out to basis with no tax implications. And then again, depending on structure and kind of policy, MEC or non-MEC, potentially wash loans. So it's not just the accumulation. I need to emphasize again, it's the distribution that could be incredibly favorable as well. And maybe a little bit related to that, Brian, what are, for people that are looking at it more from that perspective, what has been adapted during COVID-19 with some of the stellar insurance companies in the world? What are some of the dividend rates, which probably are not quite as high as they used to be, but you compare them to what people are getting on 1 or 3 year treasuries, they're probably going to sound great. If you could tell us what they are.
So Mass Mutual, who's one of the largest and most well-known mutual companies that historically been one of the leaders in providing whole life insurance, their current dividend rate is 6.2%. And the others, New York Life, Penn Mutual, Northwestern Mutual, all fall somewhere between 5 to 6.5%. So why is that the case? So insurance companies credit policyholders based off of some amount of earnings from their general account, but mutual companies have the added advantage that they also provide returns on their book of business, so that, from an actuarial standpoint, they're actually, if they're doing the right things from a reserve standpoint, expense management standpoint, they're also basically crediting back a portion of the earnings on their book of business or their whole life book of business. And third, they're also providing some of the profitability back on the other businesses that they engage in, their annuity business and their investment business. So it's almost a way in a whole life policy where you're owning equity in the company. So where you're getting 6.2% of a declared dividend from Mass Mutual after expenses inside of your policy, you might net out 3.5%, 4%, depending on age, on pure crediting that's going into your policy. And then when you're able to, as that grows and compounds, and you're able to take distributions from it, you're taking them tax-free, you have to look at that from a taxable equivalent basis, what that earning was. So if you're looking at a fixed income mutual fund that's built off of municipalities or any individual laddered muni bond portfolios where your yields are sub 3%, looking at a whole life policy where they've got a dividend history paying since, in Penn Mutual's case, I think since 1848, they paid a dividend, and Mass Mutual's since 1869. So they pay that dividend every year. So we've actually been talking to a lot of folks, and actually almost unprompted by us, a lot of investment or private bankers that we work with, where they encourage their clients to build in some whole life into their fixed income portfolios as almost an asset class play. And we've been doing a lot of that business over the last year and a half, where it's just strictly, how do I incorporate whole life insurance into our fixed income asset allocation?
I have a question for Jay, but I'll comment a little bit on what you said in a little different direction, which is going to be a good thing about an industry that gets, unfortunately, some bad press, and that's the life insurance industry. You have to realize from a perspective of if you have outside money managers, they may not be as holistic and as thoughtful and as knowledgeable as Brian just described. Meaning, in other words, if they're managing resources and they're getting a percentage of your AUM, they are less likely going to encourage you to want to do something that takes the money out of that and puts that into, let's call it a product that they may not get compensated on. In other words, there are conflicts of interest. If you don't realize that, you're being incredibly ignorant. So just be careful. Again, when I'm dealing with the super rich, and they have their own SFO that has completely conflict-free, they don't care about any of this. It's just what's going to be the best solution to the client. But that's going to be a very small percentage of even relatively the super wealthy. So just understand that the advice you're getting may come from a little bit of ignorance or simply may be conflicted. So just be a little careful there. Jay, yeah, I mean, we spoke about the tremendous death benefit, about there's ways to structure for more cash benefits. We didn't get too deeply into trust structures and trust protector and potentially ways, even if it's irrevocable, for the resources to be loaned against in the trust or access. So there's even more advantages than the ones we're talking about. But among the big anchors, death benefit, wealth preservation, income and distribution, there is an other that I feel does not get spoken about enough. And that is loosely defined by some as wealth preservation / asset protection. So depending on the domicile of the person who's insured, or perhaps the trust who has access to it, as well as where it was initiated, or if it's owned by a trust, what state, or perhaps out of the country, offshore. If you could talk a little bit that each state treats it differently, but in certain states, it may have very powerful asset protection utilization.
No, absolutely. So insurance does sort of sit on the top of a pile of protected assets. So that includes annuities also, so life insurance and annuities. And even if you personally own them, they can be very hard to pierce in a lot of jurisdictions. So for instance, I know Texas has very strong annuity laws. And so we're trust jurisdictions. And if you're familiar with trust jurisdictions, some of the better trust jurisdictions in the US are like Delaware, South Dakota, Alaska. But a lot of people in Texas say, look, I really want to have my setup in Texas for the protection of my insurance products. And obviously, you touched on another area. You said offshore, Angelo, which there are a lot of insurance companies which will write policies from places like Bermuda that are U.S. compliant, meaning that it can be MEX and non-MEX, just like we talked about. But because they're held offshore, they have sort of a very high degree of creditor protection. It's sort of almost like looked at like a qualified plan. So I hope you're not going to make me go state by state here, but I think we have the general idea that we have a lot of jurisdictions in the U.S. I think more than are not that look at life insurance and say, we're not going to be able to touch that. In the case of liability. So yes, wealth protection, creditor protection, life insurance is a great tool for that.
And many of our audience knows that especially lately, more than ever, we've been incredibly active from an international and a global perspective in families with truly, multi-billions of dollars of wealth, setting up various trusts in various offshore jurisdictions, yet having the assets and resources managed in yet another jurisdiction. There are some complexity of intertwining strategies if you're really that much of a target. That potentially make it very, very hard for that to be pierced. So life insurance, and certainly perhaps owning in a certain offshore trust, Nevis would be one example. And there's others, Cook Islands, but those are countries that have a very, very powerful track record of they really don't listen to judgments that happen in the US. Why don't I put it that way? And they don't care who it is. And it's very hard to go down there and win there. Again, we have covered some of these topics before, but I just wanted to bring it up. And again, it comes down to this is an example where life insurance is an incredibly well-rounded vehicle. When I did my master class on creating a adaptive, resilient, anti-fragile family office, and I spoke about wealth preservation, investing, and tax mitigation, really insurance or life insurance was the only one that made it into all three, because depending on how you structure, it could be applicable as really a powerhouse in all three of those situations. Brian?
And so I think it's important too to add there that life insurance isn't a tax avoidance type of scheme. It's good for creditor protection and things, but obviously if you're going offshore with some type of anti or some AML type of issue, life insurance isn't going to help you out for that. So
yes, if you're looking at it from a U.S. citizen looking to avoid the IRS, they follow you anywhere around the world. Right. It is not a play from that perspective. It is a creditor protection play for outside creditors, perhaps divorce and other issues. And again, you'll need to talk with your high-level, advanced, probably domestic and perhaps international estate planning people on, because that does get to be a very deep subject. Brian, we've been mainly focused from a personal and an estate tax perspective, but most families of great wealth own privately held businesses. Many of them may have family member and others as partners. There's significant business purpose uses of life insurance, from key man to buy-sell agreements, that perhaps you don't even need to use a cash value policy for. Perhaps a term insurance policy in those circumstances may be a better fit. If you could talk about some of the business uses for families of wealth of life insurance, please.
Yeah, so there's really four areas that we tend to get involved with that kind of marry up to the family office or complement all the work that you're doing on the estate planning side for the family office or any high net worth individual that has privately held entities. So one is very simple, just buy-sell agreements where if there's a partnership that is in place and in the event of the death of one partner, you want to have a liquidity to be able to buy the other partner out. You set that up in advance and you put insurance in place. Term insurance can be that. But there's also other strategies where it makes sense to have cash value life insurance in place where it can serve a few different purposes and it can be portable at the end of the day. So there's different ways where you can structure it, where once you've kind of gone past that buy-sell obligation, that then you'll have a paid-up policy and can take that with you. Key man or key person policies, where we've done a few of these where the single family office, when under the kind of some of the new rules that were put in place a couple of years ago, where need to have be a legitimate operating entity. So there were a lot of folks that were hired to run those entities. And what are some compelling benefits that you can put in place? Well, one, you can put in a supplemental retirement plan or executive benefit plan using life insurance for that individual, but also you put key person on them as well. So if anything happens, you need to go out and hire another individual and have a really compelling comp package to hire them away from some, you'll have the liquidity to do that. And that fourth prong was what I just kind of mentioned, which was, kind of how do we motivate and retain key talent? And so once you've done all the other things from an executive comp standpoint, using life insurance also on top of that, where you can build in some vesting and make some commitments to those key folks, so that now they've got one more piece of benefit that can go into their exec comp plan that really is compelling. Angelo, you're on mute.
Actually, you remind me, Brian, that wasn't even on my list, but let's at least briefly go over that because I have spoken with you offline about it. In the family office world, you have the family and you have the senior executives working in the family office, and let's assume they're getting proper base compensation and bonus, but the family wants to do more for them because they're talented. They want them to be incentivized, but they want to have effectively golden handcuffs so they're motivated to be more longer term employees. So there's a couple of strategies: bonus 162, deferred compensation, engaging golden handcuffs, and by far the most common vehicle to fund these, often because of the tax advantages that we spoke about earlier, happens to be, well, of course, what else? Life insurance. So if you could talk a little bit more about, from an executive benefit perspective, that's a powerful incentive / retention tool for talented executives.
Right. So there's a couple of ways to approach it depending on what you as a company are willing to put in place. So just a straight bonus program, you can put in place what commonly referred to as a bonus 162 plan, but you put in place a plan that the insured is owner of the policy as well. And you as a company are making a commitment to bonus out the premiums required to fund that policy. And you can set up where there are some hooks in there where if that executive leaves voluntarily or gets fired for cause, that they would owe back the premium. And then at the end of whatever that vesting period is, essentially just like a stock vesting plan or anything that has a vesting schedule, they could walk away with the policy, and if you design it right, it'd be paid up, and then down the road it would have a compelling cash component that you could access on a tax efficient basis, as we talked about earlier. There's also split dollar plans, split dollar executive comp plans that you can put in place where the company actually owns the benefit and makes a commitment to provide or pass on a certain amount of benefit to the key executive, who happens to be the insured, over and above the insurance company or the companies who's funding it and owns the policy, over and above their basis in the policy. So again, that can have a whole bunch of other things where, hey, from a golden handcuff perspective, if you stay on for so long, we'll continue to fund this policy and you'll have this retirement or deferred comp benefit down the road. Two age-old uses of life insurance for that executive comp space. I mean, these have been around for several decades.
Excellent. And we're going to come back to you shortly for kind of our somewhat heading to the end, our big 1-2 punch. One of them is going to include premium financing. It's a tremendously powerful resource and very good for arbitrage. We're going to get to that shortly. Why don't we jump to Jay? And Jay, if you could build a little bit upon maybe what Brian said, and I know it could be a very complex subject, but I'm sure you're going to be great at simplifying it. And that would be split dollar. So people have heard that mentioned twice during the last 50 minutes, but probably don't know exactly what that is and how it could be beneficial from an estate planning perspective, as well as an executive benefit that Brian just spoke about. Talk to us a little bit about some of the core. What is split dollar and what are some of the variations of it?
Yeah, so split dollar really grew to popularity 20 some years ago in the life insurance world, used inside of C corporations where you had some arbitrage. So if you were in a pass-through entity like an LLC or an S corp, if you were the owner, you had to pay tax no matter what. But in a C corp, you're in a lower corporate environment than personal. So what it made sense to do was to say to your executives and yourself, for a benefit, as Brian's described, is to buy a life insurance policy, loaning the money. So I would loan, if I had owned a business, let's say I loaned $100,000 a year to my key persons to buy a life insurance policy. And we could have all those handcuffs that Brian mentioned. Well, the name split dollar, I wish it was really named split death benefit, because you can get that money back then, the loan, either from pulling it out of the cash value later on, 10, 15, 20 years from now, or at any time there's a death, let's say that the employee dies, there's a split in the death benefit. So the money that was loaned by the S Corp comes back. So if I made, the $100,000 a year for 10 years, I've got my $1 million back. I can even put a little interest rate on that to get my cost of money back. So that's the idea in a business of splitting. From an estate tax application, it's a fantastic tool that when you've used up your unified credit and you've done all the gifting you can, is to then make a loan to your trust. And let's say I loan, and it can be illiquid assets, but let's keep it easy with cash. Let's say I loan my trust $10 million. My trust can then take the 10 million and invest it and grow it out of my estate. And at death, that $10 million from a life insurance policy would come back, into my estate. So it's not like you're totally giving it away, but you're using sort of your basis in a split dollar method to get appreciation out of your estate into the trust.
It's
Those
a
are
very,
yeah.
Those are two very powerful utilizations of more advanced uses of life insurance, and that was excellent. Okay, Brian, one of our star attractions of the day is going to be premium financing. If you could treat it a little bit like how Jay just did split dollar, let's not make the assumption that people really know what it is. If you could describe what it is and then talk about, especially for estate planning purposes and low interest rates now, what a powerful tool it is utilizing life insurance.
So let's put ownership and beneficiary and structures aside. So just at its bare bones, premium finance life insurance is exactly what it sounds like. So you're actually, instead of paying premiums out of your own pocket, you're utilizing a third-party lender in the current low interest rate environment to borrow from them. So there are specialty lenders that are dedicated to this space, and they all day, every day do premium financing where they premium finance life insurance policies. And there's also private banks and relationship lenders that in return for doing a premium finance transaction, they want to build a relationship with you and bring under AUM. So, and those are the likes of Northern Trust and JP Morgan and City National and BNY, Wells Fargo, so several players in this space. What you do is you design the policy where, as Jay was talking about earlier, where we'll actually max fund the policy up to those non-MEC limits and get as much premium into the policy as possible so that we can really kickstart those cash values. Why that's important is the cash values inside of the life insurance policy are used to collateralize that premium loan. And in the early years before the cash value really has a chance to grow substantially and really get that crediting, that compounded growth, if there's a shortfall, the client is required to also post liquid assets. And your usual advance rates apply to those, but suffice to say, there will be initially some outside collateral that's required that needs to be posted or pledged in some liquid form. So clients that qualify for this at the very kind of lowest level, is typically somebody with a $5 million net worth and some liquidity. Now, that's not where it typically gets applied. It's really for the estate planning cases where somebody has a net worth 100 million and up. They have adequate liquidity and established relationship with one of the private banks that do this. And it just becomes a more efficient way when you're borrowing at a spread over 1 month or 1 year LIBOR that's very competitive. So you have an all-in rate, maybe at 2%, starting interest rate at 2%. Your policy is crediting or projected to credit somewhere between 6 and 6.5%. So there's kind of this natural growth arbitrage, and right from the get-go. And it just makes sense for those families to say, you know what, I'm invested over here. I'm making adequate returns on, my money that's already invested. I don't want to disturb that. So why don't I just go ahead and use leverage right now? And most of these families are very comfortable with the idea of leveraged assets. They've already used margin in some respect. They have real estate that have loans on them. They've used operating lines to finance portions of their businesses. So it's not an unknown for them to enter into this. We manage it each and every year. We have to look at what the assumptions are and make sure that it's operating the way that we were originally looking at it to operate like. But if it is, and we're managing it each year, there's very few surprises. Now, I will say the biggest caveat is you'll see a lot of folks selling premium financing right now, and they don't know what they're doing. And I say that because they're selling it assuming that cash values are going to grow at a linear rate that is above market rates of return historically in that insurance policy. And that's where you run into real problems. There's no free insurance. We need to be servicing something up, initially. So as long as we're servicing the interest that's due each and every year, and we're designing it with reasonable crediting assumptions in the insurance policy, and with lending rates where they are, you're going to have an arbitrage that's very healthy right from day one. You will have very little surprises down the road. And it requires an extra level of attention, some understanding and leverage, but it's very compelling right now where interest rates are right now and where crediting is and will continue to be on these insurance policies.
And Angelo, one thing it does, and I want to go back to an earlier point you made about, all the different advisors sort of have to look out for something for themselves in this. And what premium financing can do is take the friction out of some of those relationships. So as an example, let's say Brian and I and a client's lawyer are working with a client, and we see that there's a huge need for life insurance and that a policy is going to cost $10 million. And so if you go to that person's money manager and they say $10 million, I don't want to give up the AUM for $10 million. And you say, no, calm down. There, we could do premium financing whereby you can keep the money under management, and we'll do this in a loan way. And so suddenly then you have the sort of the advisor on board to say, okay, I'm ready to go. So it can be the best thing for the client, but also for the best thing for the client's advisors.
Yeah, that's a good way to put it. And again, if they're ultra high net worth investors and investing savvily, although it could adapt year by year, but you look at it long term, likely there is going to be a tremendous arbitrage relative to the low interest rates that are out there now to relative the kind of investments that these people are making in the banking and institutions where they custody and keep their money. It doesn't always work like that. There's not a guarantee, but likely there's tremendous arbitrage and leverage, and henceforth, that's why it certainly has taken off. That was really good. We do have a couple of questions. They're a little out of left field. So pardon for asking some tough ones here, but I'm looking at the board right now. And I do have a comment myself about the first one, which is not going to be easy, guys, but I'll give it to you. I'll let you guys start it. Was insurance used by those in China who may or may not have wanted to get around capital control? Anyone want to go after that one? I actually, because I am active internationally, I will dive a little bit into that.
Brian, you know I'm going to take that, right? Right. So obviously, I ran international distributions for insurance companies and worked quite a bit in Asia. I just completed before COVID my 70th trip to Hong Kong and 46th trip to Singapore. So the short answer is no. So China, as many of you know, have currency controls where they're not letting people take out more than a certain amount of money per year and moving it into another currency. And so a lot of the insurance policies that Chinese people would want are in the US dollar, maybe euro, maybe sterling. They don't want it in the yuan. There's reinsurance reasons. There's all kinds of reasons that you want it in a stable currency. So most of the policies that you see purchased internationally that are huge are US dollar denominated, issued out of Bermuda for Chinese clients. That said, there is a bit of a scheme where, and I say scheme in a good way here, that there are ways to make real estate investments through private placement annuities that will block FIRPTA. So we see a lot of Chinese investors making use of private placement annuities to eliminate FIRPTA. And there are ways, if the fund you're investing in will take the wand, to do that. But outside of that very distinct application, you're not going to see life insurance, the types of policies that people want, be used to sort of get more currency out of China than you can do by law.
Yeah, wow, that was really well said. You obviously have experience at it, and Andrea, I probably suggest, and we'll give their contact info in a little while, that you have a chance to reach out, because it is a very complex issue. And I concur from my more limited experience with everything that Jay said. But yes, the strategy that he described there at the end, effectively real estate coupled with private placement solutions, and part of it depends. An advantage to the US, and we have some bad things about us too, but at the moment, it may change in the future. Unlike most other countries that do a hell of a lot of sharing of tax and other information, the US does not do that with other countries. And depending on what state that you see international families set up private trust companies and certain other vehicles, Delaware, Nevada, South Dakota, they're really, really private. So yes, there are strategies involving certain real estate plays and then utilizing advanced uses of some private placement solutions. I would say that Jay's going to be a good resource to go to on that. And again, for everyone, including those that hear this in a recording, that will be something to potentially follow up with him on. We're not going to have enough time today, and I've covered it in deep podcasts before, but on private placement, life insurance, onshore and offshore. But yes, for families of great wealth that understand some of the nuances of it, that could be an other advantage of life insurance in a specific way. Brian, let's talk a little bit. It sometimes is a little bit of an uncomfortable subject in the industry, but I guess it applies mainly to term and to UL, but I guess in theory, although not as applicable because of the cash values, maybe whole life as well. And that is, there is yet another benefit that arose about 15 or 20 years ago in the industry. And that basically is if you're classified as being terminally ill. And it may be a little bit more of a broader definition of that. It probably varies from company to company, but there could be a way to access a part of the death benefit pre-death. So again, not the cash value, but the death benefit. So that's where in term insurance, where there is no cash value, but there may be uses for that money pre-death, that's an other option potentially for liquidity within a life insurance policy.
So absolutely. So there is, like it with anything, so there are abuses in so we call them life settlements. So there are abuses in life settlements where policies were sold simply to be able to sell them down the road and generate some sort of a commission off of that. But this is very, very important. There are policies that every single day people are letting go and lapsing, particularly older folks who just say, you know what, at this point, everything's changed. I don't want to continue to pay premiums. The terminally ill folks, oftentimes, I'd almost argue that it's one way or another, it almost benefits you typically to try to hold on to that policy because you're going to get a higher payout. But if liquidity is needed immediately, there are markets that will buy that policy. But most importantly is if somebody is 70 years old or older, if they are looking to get rid of their life insurance policy, and they're just going to walk away from it outright, we as life insurance professionals have I almost look at it, and it hasn't been stated this way, but a fiduciary duty to look at all the exit options on that policy and advise that client. And so one of them would be surrendering it for something. Two would be just letting it lapse and you don't get anything. Certainly could continue funding it, but number three is shop it to the life settlement marketplace and looking at institutional buyers and showing them the economics behind it. And more often than not, you'll find some value there. And if the client walks away with something from that exceeds cash surrender value, and they don't need that policy anyways, then you have done them a service. And so we always need to look at that as an exit option, just because it's the right thing to do.
And we're wrapping up. This was a fantastic discussion about a subject, again, that requires a level of expertise more than many people think. And it's incredibly, incredibly important. I just got a text in, I guess, from one of the people on now. Hey, Angelo, I hear you talk so much lately about, billion-dollar plus families having ownership and sometimes controlling interest in offshore banks and insurance companies. Yes, that's not going to be the subject of today's discussion, but for those that are hearing this live, otherwise they'll simply get it as a recording. Tomorrow, we are doing a very deep dive into families purchasing or creating offshore insurance companies. We're doing it with Withers Bergman, a firm that you guys may know. And I'm excited about it because it is one of my favorite subjects. And usually that plays more on the captive to reinsurance to more P&C side. But there may be some interplay on the life insurance side of it too. And again, this is really going to be most applicable to really, high-level Forbes families. It's very much built around some level of tax mitigation, but really a global wealth preservation, really more than anything else. And I would remind people, someone that all of us know as among the world's greatest investors ever, Warren Buffett, one of the great advantages that he does is the interplay of the insurance aspect of it. Again, admittingly, more on the P&C side and more applicable, meaning property and casualty, than life. And again, we're going to get very deep for probably potentially an hour and a half plus tomorrow with Ed Wren and some of the good folks at Withers Bergman, and very much look forward to that. Gentlemen, I want to give you guys a chance for people to learn more about you and how they could reach out. Brian, why don't we start with you? How could they learn more about Krupin Partners and how could they reach out to you?
So very simply, there's on the FOA website, there's our profile, both myself and Mike Krupin, my partner. And our website has information as well at krupinpartners.com, all one word. And our bios are up there, our contact information are up there. And then if anybody ever wants to call my cell phone, which like all of us these days is probably the best way to get a hold of any of us. Obviously, our office knows how to get a hold of us. But if you ever need that, contact Angelo and happy to get in touch with you and share more thoughts.
I'm happy to. And yes, I've known Mike Krupin and Brian for a number of years. They're one of the true leaders in this industry. As you could probably tell from some of my comments, I'm not unknowledgeable about insurance because I do find it for incredible families to be an incredibly powerful vehicle. What I've always enjoyed about Brian is he's tremendous on interacting in customer service. And again, to get a little bit away from sometimes that negative perception of life insurance. Oh yeah, he also happens to have graduated from a little school in Palo Alto called Stanford. Brian talks about, and he's going to be modest, but he had options. It could have been investment banking. It could have been venture capital. It could have been banking, but he decided that he can make the greatest impact. And he's had a very successful career in the insurance industry. Jay, if you could tell us a little bit about your practice and how people can reach out to you.
Yeah, so the easiest way is to go to our website, lifeinsurancestrategiesgroup.com. So it's kind of long, lifeinsurancestrategiesgroup.com. On there, you'll find the usual information, but we also do a lot of blog writing on different subjects. So you'll see pieces on there like for premium financing, split dollar, estate planning. So many of the topics we've discussed today, there's articles on there that you can download and use for free. I'll throw in a commercial for your bit tomorrow with Withers. I've worked with Ed Wren on private placement cases. So we didn't get to private placement today, but Withers is a top firm in that area. So I hope your audience is looking forward to that, Angelo. And then just as a reminder about our firm. So again, we don't sell products, but we're regularly engaged by the individual clients and their families or their attorneys or wealth managers and family offices, just to help structure or answer questions about life insurance. And then we do work with some of the fantastic top tier producers like Brian and the Krupin folks in getting things implemented.
Well, thank you, Jay. And yes, I am looking forward to apparently I have a thing about insurance. So I do like to talk about it. It was great to have a chance to meet you, and not for the masses, but if you don't mind, in the Zoom chat feature for Andrea, I think she may end up wanting to follow up with you. If you wanted to perhaps just type in your phone number, she could just reach out to you directly. No one else other than the live participants today will see it. While you're doing that, I'll pretty much say a final goodbye. This was a lot of fun. I don't know if we could often say that talking about life insurance, but for me, a tax nerd, this is great. And it's so great to have Brian and Jay on. And we hope, again, even if you're not that billionaire, or even if you hear this in my YouTube or a podcast and simply are someone who's an entrepreneur or mildly successful, however you define that, life insurance is going to be needed. And these gentlemen are going to be able to be of value. And hopefully you now have a little bit more of a deeper understanding about some of the more advanced and complex utilization of life insurance, and what a powerful tool and vehicle it is for families of great wealth. And again, really any family. It provides an incredibly valuable service. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices. We do a significant amount of original proprietary content, and we host over 200 now in COVID times. So practically every day, a daily Zoom meeting for our members. We'll occasionally invite guests, but really it's focused on my members who are supportive of the organization, so we give value added back to them. And during COVID, we've created a significant number of ever-growing masterclasses and other resources to be of value. Hey, we all wish we could snap our finger and things would go back to how they used to be, but wishing for it is not going to make it happen. You have to be resilient, you have to adapt. And one day when there's the new normal and we don't have to wear a mask and we have COVID under more controls, whether 6 months or a year, really it's going to be marrying the old with physical events and interaction with the new, because they're both great and they're both valuable in their own way. But we're not resting on our laurels of what we've done for 12 years. We adapted very quickly and are really enjoying many of the aspects of a more digital age that has allowed us to be more global than ever before. So it's been an intriguing time. I'm active on social media. Our channel on YouTube, where a lot of people first learned about us because of all our videos, simply as Family Office. Very active on Instagram and LinkedIn. Shockingly, I opened one, but I haven't done it yet, a TikTok, but I have some ideas on that. So we'll see how that plays out here in the US, but it looks like with Oracle now, that would not be an issue. And my website, which has been updated over the course of the late summer, is familyofficeassociation.com. And my email is angelo@familyofficeassociation.com. Brian and Jay, thank you so much for being a great guest. Thank you.
Thank you for the time.
Thanks, guys.